Hello, and welcome to Donatian Investment. This analysis is for Broadcom on NASDAQ as of 31st of July 2026, with a share price of $388. The full report is on donatian.ca. A do not buy at $388.57, and not because the business is weak. Broadcom is a genuinely elite semiconductor-plus-software franchise, but its stock is priced at a valuation extreme, about 65 times clean earnings, just as the macro tape turned against the whole AI-capex cohort. This is a price and risk call, not a quality call, and it stands across all three horizons. Let me be clear up front, this is a high-quality company. Revenue grew 47.9% year-on-year in the latest quarter to $22.19 billion. A genuine acceleration driven by AI custom silicon, not a mix trick. Gross margin runs at 67%, operating margin 43.7%, return on equity 33.4%, and free cash flow is around $27 billion a year. On our scorecard, quality scores 86 and the underlying AI driver scores 78, a strong tailwind. Broadcom is one of the few picks and shovels giants selling into both the AI hardware build-out and the enterprise software stack at once. None of that is in doubt. Here is where it breaks. On clean trailing earnings, the stock trades at 64.8 times, that is 2.46 times the roughly 26 times multiple our discounted cash flow anchor says the business warrants, and it sits above the 28 times guardrail we hold semiconductors to outright. Either test alone caps the name, both fire, and it got worse, not better. The 10-year Treasury yield rose to 4.67%, lifting our discount rate to 9.2% and trimming the warranted multiple, so on a near-flat price, Broadcom is more expensive than it was a fortnight ago. The forward PE looks tame only because the street model's earnings roughly tripling, the exact optimism the anchor is built to discount. Valuation scores 25. Expensive on its own would cap the name at hold. What pushes it to do not buy is a live catalyst. Our do not buy trigger 2B fires when a name is deep in the expensive band and a material systemic derating catalyst is armed. Both are true. The 30th of July macro report reconfirmed the S&P 500 concentration and AI earnings quality tail as armed. The top 10 names are about 41% of the index and breadth is narrowing. Broadcom belongs squarely in that cohort. Its multiple and its revenue acceleration are directly levered to the hyperscaler AI-capex trade. Its earnings are clean, so the earnings quality half of the tail doesn't apply, but the AI-capex leverage half does, and one arm is enough. Now the honest other side, because for a do not buy, the real risk is that we're wrong on the upside. What makes this call wrong is simple. The AI-capex melt-up just keeps going. Our own base case is $455, about 17% above today, and the bull case is $560, roughly 44% up. Both sit above the current $388.57. The probability-weighted fair value works out around $421, also above spot. So on the modal path, the stock drifts higher, and this is deliberately not a prediction that it falls. It is a risk-adjusted call. Sitting against that upside is an armed bear case at $215, down about 45%, that can erase 2+ years of gains in a single re-rating. When a fat, live left tail is that severe, chasing an obviously expensive name is poor risk-reward, even when the mean is positive. Now weigh the risk against the reward. The bull case is roughly 44% above today, the base case, the most likely, about 17%, and the bear case a fall of about 45%. So you are risking about 45 to make 44. So, our call on Broadcom, on NASDAQ, do not buy. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donatian Investment at donatian.ca. The link to the full report is in the notes below. Have a great day.